Usually someone in my position makes a joke about saving the best for last, or those hardy few who stick it out. I will resist that urge. I think we've had two fabulous panels, and I just want to say again how grateful I am to CIGI and the IIF for collaborating with us. I think the whole has been stronger than the parts. And again, we're going to have a great session now. I was teasing my predecessor and mentor, Fred Bergston, that he was getting too controversial ahead of time, but I gather he focused on his WTO proposal, which was nice. If you thought that was good, wait till you get Ted Truman at the end of this panel. But before we get into that, just let me say that this is the panel about governance, resources, relationship with regional financial institutions. This is about who runs the IMF. And, you know, this may not be a what is it good for in terms of functionality to some people, but for others, this is the core issue. I met with a central bank governor of a very small emerging market today, and I said, well, besides all the U.S. governance stuff and Ukraine, what do you care about? He's like, what do you mean besides the U.S. governance stuff? That's what I care about. I'm racking up reserves because I don't trust these people. And so, you know, it all goes together. We have a terrific panel. I'm Adam Posen, president of the Peterson Institute, and thank you all for joining us. Alphabetically and also from my right to left, so your left to right, I have Thomas Bernes, who is a distinguished fellow at CIGI. Sorry, I should have memorized his bio by now. He's had a long career in international public service at the OECD, the World Bank, the IMF, and you were among the founders of CIGI in getting it off the ground, I believe. And you've been involved with the GATT, so you're one of the few people who's done both the trade side and the money side, which is always a fascinating perspective on governance issues. Next, we have Charles Collyns, who is now Managing Director and Chief Economist at the Institute for International Finance. Charles, of course, just recently emerged from the U.S. government, where he was Assistant Secretary for International Finance at the U.S. Treasury from February 2010 to July 2013, just enough to enjoy the crisis and start the recovery. But before that, Charles had a long and distinguished career at the IMF, including as Deputy Director of the Research Department. He and I got to know each other that he was responsible for its work on Japan in 97 to 2001. And I worried that when they moved him around, it was a sign of imminent danger. So when they moved him to the US in 2001, I started selling short. But it turns out they moved him 7 years too early, so that was too bad. Third is my longtime friend, Athanasios Orphanides, who all of you, I think, now know as a famous alternative to Dr. Doom. Athanasios was, of course, the governor of the Central Bank of Cyprus. Before he is not only, of course, therefore, by definition, the greatest living Cypriot monetary economist, he previously had a long career bridging academia and the Federal Reserve Board, where he was on staff of the Monetary Affairs Group. He had been a senior advisor at the Fed. He also taught at Georgetown and Johns Hopkins, and of course was famous for some of the work he did on explaining the mistake that Arthur Burns made back in the 70s, among other things. Finally, the aforementioned Ted Truman, senior fellow here at the Peterson Institute, a predecessor of Charles's as Assistant Secretary for International Monetary Affairs at the Treasury, of course, institutional baron of the Division of International Finance at the Federal Reserve for many years, and a good colleague. So, all that out of the way, let me turn to Thomas and ask you to give us a non-American, non-narrow perspective on governance of the IMF.
Okay. Thanks, Adam. It's a delight to be back here and see some familiar faces in the room. The topic of governance is one that's been kicked around a lot over the last number of years, and it's hard to think of something new to say on it, but let me share a few thoughts. First, when I was meeting this morning with some folk at Treasury, I mentioned I was going to be here this afternoon. They said, well, no doubt you're going to with the rest of them, bashed the United States, the Congress, rightly so, they said, for this failure. So let me start by bashing the United States for the failure to pass the legislation. It's ironic in some ways, because the implementation of the 2010 agreement, which was largely brokered by the United States, with indeed a leading role played by intellectually and otherwise by one of the people on this panel, we're now finding the United States isolated and the IMF frozen in its governance reform project. And it's ironic, as I say, because it's crippled U.S. leadership and credibility within the fund on these issues. And I think, as I'll try and explain, it imperils the IMF capacity to play a leading role in addressing a number of policy issues. You know, Susan Shadler said, you know, she had to answer the question, you know, what is it good for? And I mean, the title of the conference struck me too. What is it good for? And you know, I think Susan had a couple of roles. I mean, I see four roles. I mean, surveillance, research, technical assistance, capacity building, and crisis management and financing. I mean, global public goods. They are important. And on average, the fund staff do a good job. You know, I was director of the Independent Evaluation Office for 4 years, and we looked at a number of issues, and at times we were critical. Obviously, any organization can do things better, can improve, but you know, basically my conclusion was the fund did a good job. They weren't always as omnipotent as staff sometimes thought. They weren't as bad as some of the critics would have it. They did a good job. But they're really struck now with a challenge. I mean, one of the issues is you ask yourself, how does the IMF exercise leverage? And I guess, as I see it, there are three ways. I mean, one is overwhelming intellectual leadership. Well, I think the IMF can be a leader. Whether it, in today's world, can exercise overwhelming intellectual leadership, I would argue not. I think areas of expertise have grown, whether it be in academia, whether it's in the Fed, whether it's elsewhere. So its leverage is limited there. Secondly, money. If it brings money to the table, it can exercise leverage, and it will continue to do that in certain circumstances. Thirdly is through engaging with groupings such as the G20 today. Earlier it was the G7. It maximized the fund's leverage. It was also a vehicle for these groupings to exercise their leverage on the system. It raises questions of legitimacy and so on, but it is a means to do so. What we've seen, though, is that with the establishment of the G20, the role of the IMF, in fact, I would argue, has been eroding over the last few years, in part because of the criticism of the emerging markets that the fund lacks even-handedness. It's not a level playing field. And therefore, the processes that have started within the G20 have said, you know, this is a country-driven exercise. We drive it. The IMF will do as we ask them to do, nothing more. Now, and as the agenda has broadened, they get now into structural adjustment. You know, the first meetings, if you look, the G20 tasked the IMF and the World Bank. I mean, today they task the IMF working with the World Bank, OECD, UNCTAD, ILO, to produce a report. And I just saw one last week that said, prepared for the last G20 finance ministers meeting in Sydney on structural reform issues, prepared by IMF staff with input from the OECD and the World Bank. And I said, I mean, one, it was a bit of a vacuous document, but apart from that, I said, I mean, who is accountable for this? And I think that's part of the challenge, that we're bringing more and more players in, but where's the accountability? I mean, who is providing the advice? Who's to be held accountable at the end of the day? I talked about this emerging market view that the IMF lacks even handedness. Let me just give a couple of examples as to why that's the case and why that's important. Fred mentioned Paul Blustein's book, Off Balance, which is a terrific read. What Fred didn't mention is that IMF staff had gone to the senior deputy managing director at the time, John Lipsky, and said the United States should be one of the first cases brought to the board for fundamental misalignment. And John Lipsky said, no, we're not going to do that. Now, that's what's stated in the book. I've heard myself, some others, that is true. So not to deny anything that Fred was saying earlier, but there is another side to that debate, and which is why you're getting this reaction from the emerging markets that this is not a level playing field, and we want, which is why the quota issue and the ownership issue of the fund becomes so important, because until that's solved, you are going to continue to have this sense that it is an institution controlled partly by the Americans who serve their own interest. Or let me give another example, which was referred to in the last panel, and that's the case of Greece and the Troika that was set up. Now, the Troika was established to manage the Eurozone crisis with the European Commission, with the ECB, and with the fund. Never before, to my knowledge, in the history of the fund, Jim, correct me if I'm wrong, has one of the authorities sat on the same side of the table as IMF staff in negotiating the program. Certainly in the Caribbean, which had an Eastern Caribbean central bank and a number of governments that negotiated programs, that certainly wasn't how the fund staff organized itself at that time to deal with those countries. But having said that, you can make an argument, well, it makes sense. In fact, the European Commission lacked experience in putting programs together. The fund did have unique experience. The European Commission was very politicized. It was useful to have more honest broker at the table. But there's another dimension to this, and this is when you look at the board. There are two things. One is I think the point that Susan made, is staff management introduced, the board acquiesced in allowing a major change in the rules, allowing systemic importance to creep into allowing the rules to be broken. But more than that, you had a board where a quarter of the members happened to be representing two of the players on the Troika. Some would call that a conflict of interest. I would. So, there are huge governance issues that arise there, but again, it comes back to why is there this attitude on the part of a number of emerging markets that the fund is not providing a level playing field, and why that then plays back into the G20, and why the fund is being held at a certain limited capacity. So, solving the quota issue is I think, Seoul, the 2010 decision, DSK described it as historic. I described it as a small step forward. I think it was a small step in terms of what needs to be done. It did break a logjam, but it's now frozen. And until we get off of that, I think we're in trouble. And sitting here, I just don't see a way where Ted, I'm sure, will have some ideas how we can break this deadlock, but I don't see how one gets the stalemate, the U.S. Congress administration on this issue off center, and as long as that's stuck there, I think we're all stuck. Okay, resources. This is also linked to the first, but just very quickly, part of the debate, including the debate in Congress, the fund's not getting new resources. In a sense, we're shuffling money from one window to another. The fund might get more resources under quotas. The NEB commitments would go down. You can have an argument as to whether it's better put into permanent quotas versus a facility like the NAB. But the overall point, I think, is that there's not new money going into the system as part of this. Now, one can sit down and do spreadsheets and say how much resources should the fund have, what scenarios are going to have in terms of what crises. It's a matter of judgment. You can come up with any figure you probably want. I suspect the money is going to be there. On the resource side, I'm not personally overly concerned. I think the resources, if you look at the fund's resources right now, they're huge. And relative to most reasonable scenarios, and if we go elsewhere, I think, as we saw in this last crisis, the resources will be available or we'll all be in trouble. I think the more difficult question is the relationship with regional financial institutions. I think the world is changing. The Troika, how does the IMF work with the Commission, with the ECB is one element. Chiang Mai, Asia, these are all evolving. I think the rules aren't clear. The fund is no longer going to be the head, the master, the control point. I think it's going to be much more a primus inter pares, and it's going to have to learn to work with these other organizations. I think the fund has been changing and doing that, but it's going to require a change in attitude on the part of the fund. It's going to involve looking at different governance arrangements. How do we organize? How are decisions reached? And they're going to be very difficult, and they're not obvious. But it all goes back to I think, to the first point. Until we get a breakthrough on the quota issue, I think the whole thing is frozen, and I suspect that means at least until the next administration in the U.S.
Lovely, thank you. Charles.
Thanks, Adam. I'm also going to talk mainly about quota reform. In the past, anyone saying they're going to talk about quota reform would, I think, put most people to sleep. It's a very dry and arcane topic. In fact, I have been myself put to sleep many times sitting around G20 meetings discussing the intricacies of the quota formula and trying to negotiate minor adjustments to the formula. Very rapidly gets into very, very tricky and not very exciting detail. But I agree that the failure of U.S. Congress to pass the quota legislation is a big deal. I wouldn't go as far as to say it's an existential threat to the IMF. The IMF will continue, but I think its effectiveness is seriously damaged and undermined. I think that the potential for moving ahead in other areas is clearly going to be curtailed. And I would also emphasize that it's not just damaging the U.S., it's not just damaging the IMF, it's also seriously damaging the U.S.'s interest and the U.S.'s capacity to influence the fund and to move the fund to taking steps that are important in the interests of the United States as well as the global economy. I think throughout the day we've had a pretty good discussion of what is it that the IMF does that is so important. I think pretty much everyone has agreed that there are things that it does that are important, perhaps a little disagreement on some of the details, but clearly in the area of intellectual leadership through its surveillance, and it's in the area of crisis resolution, crisis response. The IMF plays a critical role, but its capacity to play the critical role in both these areas depends on the adequacy of its resources and on the legitimacy of its analysis. And I think failing to move ahead with quota reform has a particularly negative effect on the latter. I agree with Tom that on the resources front, there isn't an immediate short-term problem. The fund has, according to the estimates the fund published at the end of February, something like 839 billion of financial resources, based on a quota base of $370 billion, and the NAB credit lines of $570 billion. That provides a usable lending capacity of $625 billion against outstanding credits of $127 billion and commitments of $160 billion. So there's a forward lending capacity of over $400 billion waiting to be used. Moreover, should there be a turn for the worse, then the fund could activate bilateral credit lines of up to over another $400 billion as a second line of defense. So there's no immediate need for additional fund financing. The one concern I would have, though, is that if you can't pass the 2010 quota reform, you can't begin the next quota reform. The 15th quota review was supposed to have started last year. There was supposed to be in progress on revising the quota formula. That was the subject of all these rather dull meetings in the G20 last year that I had to sit through. That is one process that's completely frozen by the inability to complete the 2010 quota reform. But I think the much bigger problem for the fund is the implications for the legitimacy of the fund. The fund has long been viewed, as Tom and others have said, as being overly influenced, overly dominated by the advanced economies, particularly the United States and Europe. Over 60% of the quotas are held by the advanced economies. And I'd also mention that the key top two management positions in the IMF are held by a European and by an American. And not surprisingly, this dominance has indeed created a perception of bias in the IMF surveillance policy advice, a lack of even-handedness, a greater willingness to reflect the points of view of the US and the Europeans, and a lack of understanding of the points of view of others, particularly, for example, in Asia, where they often have a very different approach to economic issues. And I think this weakens the impact of fund surveillance. It also weakens the impact of the fund as a crisis responder. On the surveillance front, it's harder for the fund to come through with tough judgments if the basis for those judgments is not trusted, if there is a suspicion that the fund is not reflecting its deeply felt analysis, but rather points of view of its larger shareholders. The fund has been, I think, trying quite hard to demonstrate its willingness to listen to a broader range of opinion. I think you could see this, for example, in the new guidelines on the use of capital controls in the face of volatile capital movements. Now, if you read the decision, you might think that it's rather a pig's breakfast. It's hard to see much coherence, but it clearly reflects an attempt to take a much more eclectic approach than it has been the case in the past. But I think despite these efforts, I think the fund is still tarred with this perception that its intellectual engine is still dominated by its major shareholders. And on the program side too, I think there's a serious problem, maybe even a bigger problem, which is summed up in the word stigma. I think there is still a massive reluctance in countries to come to the fund for support at an early stage. Countries will come at the last minute when they're forced to come, but they won't come earlier when the problems are easier to deal with. And it's particularly meant that countries have not come to use the various forms of precautionary facilities that the fund has developed in recent years. 3 countries have used the FCL, but all these 3 countries are countries that are, I think, particularly close to the US or to Western Europe, Mexico, Colombia, and Poland. But we haven't seen a broader range of countries. We haven't seen countries in Asia, for example, coming to the fund. We saw none of these major countries coming to the fund, for example, in the context of the global financial crisis. And I think this is going to continue to be the case as long as the fund is seen as lacking legitimacy and as following, as being more strongly influenced by the advanced economies. Now, the quota reform wouldn't have solved this problem, but at least it would have made progress in the direction of addressing the problem. The 2010 quota reform would have raised the quotas of the emerging markets and developing countries from 39.5% of the total to 42.3%, which would be more or less in line with the share of these countries in global GDP when measured as a blended average of market exchange rates and PPP. So it would have been progress in the right direction. However, it would have still have left quite considerable imbalances, particularly with the BRICS. The BRICS are substantially underrepresented in the fund. Even after the 2010 quota reform is approved, they would still only have 15% of quotas compared to 22% of their share of global GDP. And on the other side of that is the European countries, which would have 30% of quota compared to 24% of their share of global GDP. And this really reflects the design of the quota formula, which gives a heavy weight to trade openness as one of the factors determining the allocation of quotas. And one of the big debates we've been having is try to figure out a simpler, more transparent formula that gives a heavier weight to GDP, less weight to openness, that would have helped increase the share of the BRICS. The other issue, which again Tom mentioned, but I think is important to emphasize, is the issue of leadership. I think there has been some progress towards developing a more transparent selection process based more on merit than on nationality. But the reality is that it hasn't actually delivered the results that are intended. And so we've maintained this pattern of choosing a European for the IMF and an American for the World Bank. I think part of the issue is that the Europeans are actually much more effective, much more united in coming up quickly with a candidate, and the emerging markets tend to not want to support each other's candidates. I mean, even a very strong candidate like Agustin Carstens failed to receive much support in the last leadership round. But I think it just reinforces the perception that countries have that the emerging market voice is not really recognized. Let me just say a few words on the U.S. And the damage done to the U.S. influence in the fund. I think the U.S. Clearly relies very heavily on the IMF as a major partner for ensuring a stable international monetary system. I think the key area where the fund is able to act in areas where the U.S. is really not able to act is in the area of crisis support. And this is true also of the European countries. The fund is able to move very quickly with large amounts. It's able to take risks. It can be pretty bold. And I think the recent announcement of its willingness to support the Ukraine is a good example of this. So the fund came forward and said, we're prepared to put $14 to $18 billion on the table for a 2-year program for Ukraine. At the same time, the U.S. put forward a $1 billion loan guarantee. And frankly, that's pretty paltry. The budgetary implications of a $1 billion loan guarantee is only a few hundred million. The process is cumbersome. The money won't come quickly. It's not really commensurate with the geopolitical importance of supporting the Ukraine. And frankly, the Europeans didn't go very much further. Similarly, in the Arab Spring, the U.S. bilateral contribution that was on the table for countries like Egypt was really very limited compared to what countries could get from partners in the Gulf. So the U.S. cannot exert influence directly very effectively through balance support, but it relies instead on the role of the IMF. There is this exchange stabilization fund that the U.S. has. It's worth $100 billion. It provided $20 billion in the case of the tequila crisis. But that was 20 years ago. And the very strong pushback from Congress after that has meant that ever since then, the U.S. Treasury has not proposed use of the ESF for balance of payment support, not even in this recent case with the Ukraine. I think clearly if the U.S. is not able to push forward this quota legislation, it will substantially lose influence at the IMF. We're already seeing this. I think there's very strong reaction, particularly among the emerging market countries, among the larger emerging market countries, the BRICS. I'm sure we'll hear more of that this week during the spring meetings. And I think it's ironic, too, that one of the consequences of not pushing forward the quota reform and continuing to rely heavily on the NAB is it actually increases the capacity of the emerging markets and the BRICS to control the fund's activities. For example, the continuation of the activation of the NAB depends on achieving an 85% support from the contributors to the NAB, and that gives the emerging markets an effective veto on the use of the NAB. So I think it's a serious problem, and I end with the point I made in my introductory remarks this morning. The fund has been a very effective agent in the past, but for the fund to continue to be effective in the future, it needs to continue to update itself. But if it's caught with institutional inertia, then I think the fund will lose influence and it'll be superseded by other approaches. Thanks.
Charles, just a quick question with your new IIF hat on. And this is intentionally meant to be challenging, but I'm sure you have a right answer ready. What about those who say that the fund is not only unfairly governed in the sense of weighting the views of the West too heavily? What about those who say that the fund is unfairly governed, that it weights the views of the creditors or the markets too heavily? Is that a governance issue? Is that a myth?
I think that's a myth. I mean, at the IIF, we're concerned that the fund is now proposing shifts in the framework for sovereign debt restructuring. We had a bit of a discussion of that this morning, that shift the balance too much toward the debtor countries. It's always a difficult balance to strike because on the one hand, you want to protect the rights of creditors. On the other hand, you want to make sure that there is an efficient mechanism to deal with bankruptcy problems as they arise. And the IIF's view is that you need to do that in a market-based contractual framework rather than putting too much rigidity into rules that would make the fund override the interests of creditors in an excessive way.
Very good. Nicely done. Thank you. Now turning to Athanasios, who I'm sure will be able to tell us just how wonderful it is to be a European getting huge amounts of money from the fund in the Troika's tender embrace, right?
A pleasure to be here and give you a glimpse of that. And indeed, hearing about the European view and whatever that means is one of the issues on the table. And indeed, the IMF has been criticized for dealing with the crisis in Europe differently from earlier crises. For example, in Asia and Latin America, we just had comments about the level playing field issue or the lack of even-handedness, and this raises a number of questions about the governance of the IMF. And indeed, on my perspective, having seen the first half of the euro area crisis from the inside in Europe, and the last 2 years from this side of the Atlantic, I want to focus on the role of the IMF in Europe and the governance issues that it raises. You may ask why this is important now. You know, isn't the euro area crisis over? Well, It's great that markets...
That's the subject of tomorrow's breakfast in this room, by the way.
So I just say that it's great that markets are so incredibly and nicely complacent right now, but let me just say that the euro area remains fragile in my view. The second element is that we need to remember that during the crisis we had European politicians serving at the helm of the IMF. And that happens to still be the case. So whatever problems we've experienced the last few years and whatever governance problems have been created, unfortunately, whatever conflicts of interest that were just pointed out are still with us. So we need to worry particularly about the euro area and the continuing crisis, even though I hope that nobody will notice that it's still in a crisis. So I'm gonna organize my points around two sets of questions. First, about how the governance has hampered the contribution of the IMF to the euro area crisis. And to this one of the questions that can be asked is, well, is the euro area a single economy? Should we be thinking about it as a Europe or a euro area question, or governance or position? Or is this just a collection of separate economies that share the same currency? And one thing I want to start with is by noticing that the IMF has been doing very nice spillover reports during the crisis. And in those reports, the euro area is treated as a single economy. What's examined is very nice. The impact of the euro area crisis, for example, or an additional worsening in the euro area on China or the US as examples. From my perspective, it's been very strange that the impact of euro area decisions inside the euro area and the distributional impact inside the euro area hasn't been mentioned. And that's one of the issues. The other issue has been mentioned just a few minutes ago. Which side of the table does the central bank of a euro area member state sit when an IMF program is discussed? Next to the IMF or opposite to the IMF? It has been quite unique in this situation that the ECB, as the central bank of a euro area member state, should have been sitting on the other side of the IMF, I believe, next to the government of the member state, but this is not what has been happening. And there has been a number of decisions that are influencing differently different member states in the euro area, where I think that the IMF could have helped the Europeans, here I can actually use them as a collective, to see clearer about the damage that was being done, the contagion that has been harming some member states in the euro area, the benefits that were happening in other members of the euro area as a result of these decisions. I can list a couple. One is the PSI decision in October 2010 that reversed the IMF ordering on you first examine sustainability. If a country is sustainable, you give a loan. No, that decision was saying, no, if it's about a euro area country, first you involve the private sector, and then you consider making a loan, which of course created the contagion in Europe. Or another one that is very close to my mind because of what's maybe happening, what is happening the rest of this year. If you go back to 2011, we had the July and October stress test exercises without a backstop. And again, that's a sort of decision that can create systemic issues and differentially impact some countries beneficially, some countries adversely. I think the IMF could have guided Europe better in those instances by offering analysis on how these decisions damaged economies inside the euro area, instead of looking at the euro area as a whole, which was much of the emphasis. But the second set of questions I have is actually, in my mind, more challenging, which is, whose interest does the IMF serve when participating in a Troika program in the euro area? What are the additional constraints that appear and have appeared and continue to appear in the euro area because of the construction of the euro area and the interaction of the euro area and the IMF? And a couple of these issues have already come up, but there is one peculiarity of programs the IMF got involved into the IMF that is really unique that I want to highlight, that has not been highlighted before. Take Ireland as an example and think about Ireland before getting into the euro area and after getting into the euro area. Let's say Ireland needed consultation and a program with the IMF in the 90s. It was not the case, but let's suppose that it did. It had its own currency, it had its own central bank. If you had to do that and they needed some assistance, then government, the central bank would come here, would negotiate with the IMF, a program would be designed in a few weeks. The IMF board of directors would consider it, it would be done. Note that in this process, no other European government could veto details of the program, add elements to it, or otherwise obstruct what the IMF could recommend for Ireland in that case. And then consider this with Ireland in the euro area, what we've seen in 2010. In that case, for the euro area members, for euro area member states right now, the IMF de facto allows every other government to have veto power on details of a program. As a result, what is observed, in my view, is that programs are not designed to serve necessarily the interests of either the global economy or the country involved, because other interests actually interfere with that. Let me remind you, in 2010 and 2011, in the case of Ireland, we had serious discussions appearing about the tax regime in Ireland, not because the IMF was bringing it up, not because the Irish government was bringing it up, but because some other member states of the euro area that are large and have a lot of influence at the IMF were bringing these things up. These conflicts create severe problems that are detrimental for the programs and have added fuel to the crisis in the last 4 years. And what's even worse is that as a result of these governance problems and the effective veto that some member states, that all member states in the euro area have, whenever the IMF gets involved in a Troika program, the IMF got involved. It didn't want to, but it got involved in the process of shifting losses from the crisis from stakeholders in one country to stakeholders in other countries. We have this situation that too often in this crisis, the IMF deviated from technocratic prescriptions and fell prey to political interests in some euro area influential member states and whatever special interests those governments represent. A couple of examples have been mentioned already, but I'm going to give them to you with a different light. Take the decision in 2010 involving the Irish debt on bankrupt banks that was held by other banks, including, as I understand, largely by other euro area member state banks. As I understand, has become public since then, the IMF technocratic position was that the Irish government's thought that losses should be imposed was supported by the IMF. However, in the end, the IMF agreed to a program that imposed all of those losses to the Irish taxpayer. Not quite the technocratic idea that you would want to have. We've also heard earlier today about the 2010 decision in Greece. Again, I want you to do the analysis in terms of the pure economic costs and shifting losses around. You have to go into your mind and maybe using the BIS exposures data think, who exactly were the holders of Greek debt in 2010? Which member states benefited from delaying the restructuring of Greek debt and coming up in the meantime with a very nice scheme of unloading holdings of selected banks onto the ECB, and then a decision much later in the process to protect the ECB holdings from a haircut. This sequence of decisions had very real consequences in terms of shifting losses around. It got even worse. When I consider what happened in Cyprus last year, I see an IMF that implicitly, unfortunately, got very deeply involved in member state politics. In the case of last year in Cyprus, we had a solution that was not the solution the Cypriot government wanted, not the solution that the European Commission wanted, or the majority of the euro area member states. Unfortunately, there was a very large euro area member state whose government was facing an election last September. And that government formulated a plan that best suited it for that election. And the IMF was in this very weird position that it ended up actually aligning itself with that particular government because it felt it had to support a very influential euro area member state and the electoral considerations of that government later in the year. That's not how you would want IMF programs to work, really. It got even worse than that. After the events of March 2013, it also became known that several billion euro of assets, about 20% of Cypriot GDP, were shifted from Cyprus to recapitalize a specific bank in Greece that was apparently bankrupt before this amazing trick, raising additional questions about what is the role of the IMF in shifting losses, in this case, from one state under a program to another state under a program. Really strange stuff. So I'd agree that there is no question that the IMF has been dealing with the euro area crisis differently than other crises, in a less technocratic fashion, in a more political fashion, being unduly guided by politics in some large member euro area states, not a European voice as a whole at all. And this is unfortunate for many reasons, the worst of all, because it damages the reputation of the IMF and limits the good that it can do to help maintain global stability. Because I also thought about, the topic of today's meeting, the IMF, what is it good for? And when I think about this question, I think about all of the untapped potential that can be had by having an institution like the IMF protect global financial stability and improve growth, which was one of the articles upon which it was founded. So I'm going to just end with one very obvious policy recommendation to improve the governance problem that could be done immediately. There could be an immediate agreement that politicians from large euro area member states are ruled out as candidates for the leadership of the institution. Let's just stop here.
Why stop? That sounds good. A very quick question, Athanasios. I mean, that was fascinating. For the problem you confronted, in your view, would quota reform have made any difference, or is it just Germany is too big and like Mexico to the US, you're just too close?
I think the quota reform would have made absolutely no difference because it was just discussed. For all of the programs, all of the variations of the formulas discussed still allowed a select number of European countries to maintain a lot of influence in the process. I think what would have made a big difference would have been if we had leadership at the IMF that was based on technocratic criteria instead of being driven by European politics. And there, we've heard variations of this already. I think in that case, the IMF would not have been playing the politics of the large member states in the euro area, and things could have been different. I think we would have been out of this crisis in that alternative counterfactual.
Very good. Thank you, Athanasios. Ted, maybe it's not all Europe's fault, right?
Is that a cue that I'm supposed to start talking? Okay. So Thank you. Maybe like Willem Boyter, I'm going to issue a disclaimer that the views I'm expressing are not necessarily the views of the Peterson Institute for International Economics, its president, present, somewhat associated with the past president, but certainly not anybody else. Indeed, they're not widely shared within the institution. Because I'm going to talk about whether it is time for the United States to risk, and I want to emphasize the way name risk, its veto in the National Monetary Fund. In fact, my proposal is that it is. I am conscious of the fact that I'm the last speaker here, so you may see this as an issue of offering some comic relief. And by the way, I've already been told by a close friend in the audience that a petition is being circulated to seize my passport so I can't get out of the country and can be prosecuted for disrespect for the United States government. So with that beginning, I would submit that the support for the International Monetary Fund is at a new low. I think we've heard quite a lot of that on this panel as well as the others. The reasons are many and varied. The lack of that support is not limited to the United States. The United States is not, the IMF is not politically popular, not just among the men and women on the streets, most of whom have never heard of it, but also among political elites, including those represented in this room. And the most recent indicator of U.S. lack of support for the IMF is the failure of the Obama administration and the Congress to incorporate the IMF Quota and Governance Reform Agreement into of November of 2010 into the legislation supporting Ukraine, even though that legislation in itself, as we've just heard, said by the former U.S. official, was on the puny side. So the IMF faces, as Fred said this morning, an existential crisis. And in my remarks, I'm going to step back first and say a few words about the question that we're all sort of required to answer about why it's important, and then propose a way out on the governance issue impasse by risking the U.S. veto in the fund. What is the IMF good for? We've heard many answers. My answer is similar to those given by others. It delivers a wide range of public goods, global public goods. It does so, and I think this is important to remember, by a collective commitment by its members to exercise their rights and discharge their responsibilities to produce outcomes that no single country could produce. For many, those public goods are associated with the economic and financial crises. That was the focus of the previous panel. I think it was reassuring that that was not the focus of the whole conference, since that's a great distortion. I will offer you a few facts. One is that about 15% of the IMF budget is devoted to lending activities in all forms. Bilateral surveillance covers remaining 16%, multilateral surveillance 22%. What they now call capacity building, and we used to know as technical assistance, is 17%, and the governance and support activities are the residual 29%. But unfortunately, the ability of the fund to deliver this wide range of public goods has been undermined by the stalemate on the IMF governance reform, stalemate caused by the United States. The IMF legitimacy has been undermined, reducing incentives for countries to cooperate with and through the fund to address other international economic and financial issues. And that, in turn, has been caused by the inability of the United States administration to persuade the Congress to act on the Korean package. And this brings me to part two. Delivered in the spirit, long associated with the Peterson Institute for International Economics, of responsible excess, I have a proposal to break the stalemate, which involves thinking about the unthinkable And in brief, the United States Congress should be put up to shut up, or shut up. I propose to put at risk the U.S. ability to block or veto certain decisions of the membership of the fund. Those are decisions that require an 85% majority of the total voting power. In brief, it's time for the U.S. to either embrace IMF reform or get out of the way. So let me explain a little bit. As you know, a member's share in quotas is the principal determinant of its share of IMF votes. The U.S. share is 17.7% of quotas and 16.7% of votes. So consequently, the United States has the capacity to block a small number of IMF decisions that require 85% majorities. For example, those proposals involving proposals to change, I want to emphasize that, the quota of any, I want to emphasize that, any IMF member, and amendments to the IMF Articles of Agreement. Moreover, resolutions by the governors approving proposed changes in quotas normally incorporate a provision that none of those changes can take effect until members with at least 85% of the total voting power accept the changes in their quotas. Technical word is consent. Alternatively, as with the 2010 package, the effectiveness was linked to another provision, such as the amendment of the Articles of Agreement, which in turn requires an 85% majority vote. I have to confess that I've long been uncomfortable with the U.S. executive branch's posture, emphasizing repeatedly to Congress over my 40 years in Washington, that the 42, I guess it is, that the United States has and will retain this veto power. The status quo cannot go on forever. The size of the U.S. economy and financial system and the global role of the United States has been steadily shrinking since the Bretton Woods Conference in July of 1914. I'm older than Jim, so I was 3 years old and about 150 miles away. That trend is a tribute to the success of the International Monetary Fund as an endeavor. In the meantime, the rest of the world has been remarkably tolerant of the U.S. political processes that often delay implementation of important IMF decisions, often for a decade or more. However, the world will not tolerate a continuation of the U.S. exercise of its rights in this area unless it does so with reasonable responsibility. And that exercise of rights should not undercut the legitimacy of the fund or its capacity to deliver global public goods. The almost 4-year delay in approving the IMF reform package has damaged the IMF's legitimacy, a package, as Charles emphasized, and others have emphasized, and Tom emphasized, that we largely were responsible for creating. And it damaged our influence in the organization as well as other areas. And in brief, we have failed in our responsibilities. So, of course, the first best solution is for the Congress and the administration to reach a deal soon to implement the package, and we can all go to the seashore. But absent quick action by the U.S. Congress to approve the package, what should be done? So I have a 4-part proposal. First, the United States administration should seek to set aside the 2010 package. Secondly, the technical amendment of the Articles Agreement that provides for an all-elective executive board should be separated and resubmitted as a standalone element that requires an 85% majority vote, including by the U.S. Congress. Third, the IMF quota reform component of the U.S. package should be amended and combined with the 15th quota review that Tom mentioned. As part of that 2010 package, most of you will know, that review was to be completed by January of next year. Actually, it was supposed to be completed by January of this year, along with the revision of the quota formula. And it was expected that that would deliver another shift in voting power, principally from the Europeans to the emerging market and developing countries. So everything is at an impasse, as Tom said. And fourth, we have to break this impasse on quotas, and that's, I have a three-part initiative on this aspect. So first, let's revise the quota formula to increase the weight of GDP, blend GDP, which is 60% at market rates and 40% at purchasing power parity, from its current 50% to 90%. Second, total quotas should be doubled again relative to the size anticipated in the 2010 package. And third, and this is the key element, but the others are relevant, the IMF Governor's Resolution on the revised changes in quotas should provide that they will take effect only when consents are received from members with less than 85% of the voting power, say 80%. So let me expand on these three pieces. With respect to the first part of the new package, the quota formula, if the rise formula were based only on blend GDP through 2011, as measured through 2011, IMF quotas were again doubled. The increase in quotas was distributed according to the new formula. The U.S. quota would increase from 17.4% under the 2010 quota proposal to 19.5%, though the United States might agree to contribute some of that to other countries. Well, however, the combined share of the European Union would shrink from 30.3% to 27.2%. This would imply a substantially larger decline in the combined EU share quota than the puny reduction of 1.6 percentage points involved in the 2010 package. And this aspect should be attractive to the emerging market developing countries, in particular if the United States were to contribute some of its increase. With respect to the second part of the new quota package, the further doubling of IMF quotas, the increase in usable IMF financial resources would be about $550 billion, raising the total to about $1.4 trillion. The increase in usable resources would be less than the headline figure, which would be $735 billion, because quotas of about 25% of members are generally not usable in lending. It is important to remember in all this, and this was the point of this whole package, that the principal way voting shares in the IMF are reallocated is via increases in total quotas that are distributed differently than current quotas. Aside from the governance aspect, an increase in IMF quota resources of this size would merely make permanent the $461 billion in additional ad hoc bilateral borrowing that the IMF Managing Director, Christine Lagarde, lined up in 2012 that I think Charles referred to. This increase in IMF financial resources would be sufficient to carry the fund through the middle of the next decade, which is the earliest date that the 16th General Review of the IMF quotas is likely to take effect. So the third and final piece in my initiative here is of course the most radical one. If the IMF Governor's Resolution on the increase in quotas sets as the trigger for its implementation at less than 85% of the total votes, and remember, that resolution itself has to pass by 85%, but its implementation does not have to require 85%. And to set that implementation at less than that, technically at less than 83.3%, depriving the United States of the capacity to block the implementation via its non-approval of an increase in the U.S. quota, the United States would be forced to, in effect, put up or shut up. The U.S. Governor of the IMF, who, in case you don't know it, is the Secretary of the Treasury, could vote for such a resolution by the IMF governors without the approval of the U.S. Congress. U.S. law only requires that Congress approve any consent to an increase in the U.S. quota. No doubt, Secretary Lew would be roundly criticized by many in Congress and U.S. punditry if he were to take this step, as I expect to be, for my advocating it. But the United States would be seen to, by the rest of the world, to be exercising its right in a manner consistent with its responsibilities. Consequently, Absent action by the U.S. Congress, the U.S. quota and voting share would be reduced to 1/4 of its current size. U.S. capacity alone to block other institutional changes in the IMF would lapse. But before you start cheering, this situation likely would be temporary because normally countries that have not yet consented to increases in their quotas are granted a grace period to do so after the initial proposal has taken effect, and I presume that would continue to be the practice. So under my proposal, the United States would set an example for other members of responsibility in exercising its rights. This would help to restore the legitimacy and authority of the fund, as has been discussed extensively by this panel, among others. The Europeans who have been recalcitrant in agreeing to a reduction in their combined quota share also would be put on the spot. At the same time, the major emerging market and developing countries, which would benefit from a resulting reallocation of quota and voting power, would come under increasing pressure to act more responsibly in turn. For example, with respect to their exchange rate policies, reserve accumulation, investment, and transparency and accountability in these and other areas. Thank you very much.
Wow. Thoughting. Joking aside, I think it is...
Pay my legal fees.
Joking aside, I think it is an important moment, and you'll see you have the paper that Ted has prepared, and again, Fred Bergston is also on a sort of similar path. While I, as with all things from the Institute, our individual scholars are responsible for their views, there is no one Institute position. I think it is an important moment to realize that people who've served at the highest levels in the U.S. Treasury and advocated for the U.S. government's role in the IMF and defended it through many years are rethinking whether we've crossed a barrier, or as Ted put it, it's time to put up or shut up. We certainly don't want you to shut up, so in our remaining time, which is non-existent, I'd like to open the floor for questions and comments. We have a roving mic at the front. I see someone has loped to the back microphone. If you could identify yourself and state a question, and if there's a particular person you want to ask.
Yes, I'm Ole Haverlishen, IMF RETD, and also a lot of other places RETD. I thought I was going to come up with a crazy idea, but I'm glad to hear that there are others that, well, if not crazy, in Ted's case at least, radical. I'd like to make a couple of comments about the political influence issue. A very quick one on the EU. We've heard lots today, including from Thomas, about how political influence affected the way in which the Greece situation was handled in Ireland and so forth. But I think I'm not going to say anything new, but I missed a little bit hearing about not the contagion of financial concerns within the Eurozone, contagion of Greece on Italy and Spain, but the contagion that the major political leaders in Europe worried about, the contagion of Eurozone fragility on EU stability. I think that drove a lot of the thinking. The second point I want to make, and this has to do with my Ukrainian connections.
Could you try to phrase it as a question,
Yes.
just for fun?
Okay. The second point I want to make, or second question I will ask, is Ukraine has been mentioned several times as if the decision to go ahead quickly were political. Well, I have no doubt that there were political influences, but I think one is overlooking to look closely enough at the nature of the economic program. This is a new day in Ukraine. I think you have to look closely. The IMF description of what the opportunities are, really, this is not 140% debt to GDP ratio, it's 40% debt to GDP ratio. So the situation is entirely different, and the situation is different in terms of the economy, opportunities. Is this really a political decision that's being made, or is it a really economic crisis with a window of opportunity to do something about it? And last, my radical, crazy idea, it was fine throughout the day to hear about political influence, and we need to do something to mitigate. But for the most part, we heard very little. How about another small step, much smaller than Ted's proposal, on mitigating political influence? Wasn't, Jim, at the beginning of discussion on Bretton Woods, a proposal made that the board should not be sitting in place in Washington, but should be flying in, well, at the time, boating in? Today, it takes a lot less time. Wouldn't having the political influence, at least on a day-to-day basis, out of the hair of management and staff, be helpful to do some mitigation? Of course, there are other mechanisms, and political influence will continue. I have no doubts about it. But can't a little bit be done of that sort?
Thank you, Ola. Before I let my colleagues here decide which parts of Ola's question fest they would like to respond to, well, I'll do that in a second. Just because they did that doesn't mean I will. But secondly, I have to plug. We are going to be talking about Ukraine and Eastern Europe on Thursday afternoon at the semi-annual joint Moody's Investor Services PIIE Sovereign Debt Seminar. And Ola was involved with a project that our Anders Aslan and Simeon Jankov are leading on taking lessons from Transition Europe and getting the real story from those who actually performed the transitions, and coming up with an action plan for Ukraine, and that publication will be coming out shortly. Do any of my colleagues here want to respond directly, or are we going to collect? You think we should collect? Yeah, I'm well aware of that. You, please. So could we get a microphone to this gentleman?
Hi, Marty Weiss from Congressional Research Service. Before we kind of cross the Rubicon with Ted's suggestion, the IMF quota request is part of the FY 2015 budget request, which there'll be hearings and it'll be marked up. If you were back at Treasury, Charles as well, how would you advise Secretary Liu to prioritize this? And what trade-offs, there's been some suggestion, some talk on the House side that they'd be willing to, maybe that the opposition is less ideological, as rather, political. What could be achieved, as well. So, what would you be willing to? What would be a successful legislative strategy, and what would you be willing to trade to get the quota reform?
Thank you. I'm not. I'll try to end up with a question.
No, actually, then please take the microphone away from him.
No, I will. But just, Tom asked me to correct him if on the point about whether what's happened with the Troika is unprecedented. And I think when in 1994, when the fund was negotiating a devaluation of the CFA franc, it first negotiated with France, and when in the final negotiations with the CFA countries, France was really on the same side of the table as the IMF. So that's kind of a partial precedent of what happened. On Ted's point, I think just to reinforce his point, the 85% participation requirement is not normal. That there have been 8 quota increases before the 2010, and the only one that had an 85% requirement was in 1998. On all the others, the quota increases could have taken place without the participation of the United States. And I think it was really a scandal that the U.S. was enabled to force this 85% requirement in 1998 without a fight. In response to Ole's point, yes, it's true that John Maynard Keynes fought very hard to have a non-resident executive board. The problem with that proposal in trying to implement it today would be that if you had a non-resident board, that would leave one executive director who was down the street from the building at all times, and that would be the U.S. executive director. So I'm not sure it would really solve the kind of problems. So my question is everybody agreed with that?
Thank you for being brief. Why don't you go to the back microphone if you could? And then Landon, you'll be the last one if you follow him.
Russell Kincaid from Oxford University and formerly the IMF. Question to Ted. Why not just have a ad hoc quota increase rather than your proposal and leaving the 2010 reform on the table? You wouldn't have to have all the complications that you've presented.
The last question at the back, Mike.
Thank you. Landon Thomas, New York Times. Just, I guess, in response to this notion that perhaps more weight should be given to emerging markets, if you look back at the Euro crisis, a lot of the intellectual power within the fund was Eurocentric, and I think some have made the point that perhaps because Europe was so close to it, they might have missed some of the warning signs, either purposely or perhaps just because they were too close to it and didn't have the distance to see what was going on. Is there a concern perhaps if we do give more weight to emerging markets, as we see some of the imbalances and uncertainties in the world shifting towards emerging markets, that we might run into the same problem where the emerging markets take on more weight, more power, but then perhaps the next round of problems are going to come in emerging markets, and will they have the ability to sort of see again some of these problems, even though they may even be part of the problem? Thank you.
So we're going to go in reverse order. Ted can answer what he wants, and then we'll end with Thomas and what he wants.
First, is Ukraine political? Yes. And I think you're going to see, but I forecast you will see in the discussions of the Ukraine program, and you've already seen it in the public pronouncements of a number of the countries, that in particular the leading emerging market countries are not particularly comfortable with this. They feel that they're being jammed down their throat in an environment in which they aren't given anything on governance. So it certainly is political. Whether or not it deserves to be on its merits is a different case, but it's perceived to be political. Priority to the IMF package, I'm not going to, that's above my pay grade. I mean, I do, with one qualification. I think the scope within the U.S. political system to include in the IMF legislation consideration of issues that have to do with the U.S. involvement with the fund, right? So with germane, if you want to put it that way, to the legislation, but trading off other other political issues, as I said, is above my pay grade, but I think it is important, and that's where the administration has failed, to make this, raise this to the level of an important international issue. No speeches by the president on the subject, no letters to Congress, no involvement of the Federal Reserve as the alternate governor of the International Monetary Fund, delaying and putting it through. So there has not been the political push from the administration, but I'm not going to deal with the trade-off. On Jim's point, and which I think I knew but didn't know entirely, part of that was before we could block it with a larger majority, so your numbers are not quite right. In 1998, we fixed things, but that actually goes to Russ's point. Sure, you could have a bunch of ad hoc quotas, but as I emphasized, you could increase everybody's quotas but ours, but the Secretary of the Treasury would have to vote for that too. And you couldn't the resolution of the governors requires an 85% majority vote. So there's no way of increasing ad hoc increases in quotas, so John Snow voted for the 2006 ad hoc increases. It required a vote of the governors of the fund. He had to vote for it. I was surprised, given that he was at war with China at the time, that he voted for an ad hoc increase in the quota for China, but he did. So that is, I think, not us. I mean, the United States want to do that, fine, but it's certainly they are better off with my proposal than with yours. And on Landon Thomas's point, certainly that's a risk. I mean, but that goes with the world, and I think the point is, and that's part of the issue here politically, the United States has been driving the fund, if you want to put it that way, for 70 years, right? It has taken largely responsibility for what it does, for better, for worse, right? It's time for other countries to take on responsibility. The message that Fred Bergson gave earlier at the beginning of this conference was other countries have to step up and take on their responsibilities in terms of the management of their policies and their responsibilities for the international monetary and financial system. And that's where rights and responsibilities go together.
Let me start with the same question as well. So in my view, if the voting power is diffused and the more diffused, the better, that would give us a better chance of a more technocratic institution, less influenced by politics. Because at the end of the day, we're going to have the political influence there anyway. The issue is how to reduce that and elevate what would be the technocratic advice we would expect. That would be the ideal to get to in my view. So I wouldn't worry about raising the weight of emerging markets to what it should be based on GDP, population, trade, and other formulas that are under consideration. Let me also address the issue on the euro area crisis decisions. Was a concern that contagion in the euro area, in light of the fragility in the euro area, could actually impact on stability in the European Union more broadly? The answer is yes, absolutely. I could take each one of the decisions that have been taken sequentially during the crisis and always come up with arguments pro against reducing contagion. In May of 2010, I could have made the case for allowing just the IMF to solve the Greek problem, and I think the crisis would have been over if Europe had done that. Or I could say, well, let's find a European way, let's mutualize the losses and end it here. There are different ways of ending the crisis. The point is that every crisis has some cost that needs to be dealt with. And what we've seen in the euro area crisis, in my reading, is that there was nobody in Europe who cared about minimizing the cost of handling the crisis. And instead of handling the crisis, we ended up having a sequence of decisions whose primary influence, however they were justified, some of them were justified on stability considerations, but their primary role seems to have been to shift losses around from country to country to country. And look where we've ended up. Suppose that the original problem was a 50% of Greek GDP. Let's say that was the original problem. This would have been 1 percentage point of euro area and GDP back in 2010. 1 percentage point of euro area and GDP. Because of the mess we've created in Europe with the help from the IMF, if you look at the statistics now, you're going to see that GDP in the euro area is about 5 percentage points below where it would have been without the euro area crisis. If you just had the same path here in the United States with a global financial crisis, GDP would have been 5 percentage points higher right now. So because we couldn't figure out how to handle a crisis worth 1 percentage point, we actually created this massive problem. That's the issue.
I will follow Ted's excellent example in ducking the question on legislative trade-offs. It's certainly above my pay grade and expertise. I think the key point is to demonstrate the importance of passing the legislation by building a broad coalition of support in the business community, the financial community, the foreign policy community, as well as us IMF policy wonks, to convince both sides of Congress that this is really essential legislation and it's deeply damaging to U.S. interests not to move it forward. On the Ukraine question and whether it's political or technocratic, I don't think it's a bad thing for the IMF to be political. The IMF is a policy-making institution, and to be effective, it has to have a good political sense. I think the managing directors of the IMF who would be most effective are those ones who are the best politicians. My point is not that the IMF should become less political, but that the political forces should have a better balance, that they should better reflect the global economic balance of power, rather than the balance of power within Europe. And I think this is Thanos' point too. The IMF is just too dominated by local interests rather than by global interests. So the IMF is not just something that looks at the European politics, but looks at the global interest. And I think that is essential to maintain the effectiveness of the IMF going forward.
On Ollie's question on having a non-resident board, I mean, in fact, I think you see today with the G20, what's happening is surveillance of the G20 countries has shifted to the G20, where countries fly in their representatives from capitals for the MAP process, the mutual assessment process, and the board discussion is perfunctory. So in fact, and that's my concern, that surveillance function for the most important countries is shifting out of the fund, which is why I think the governance reform is so important. So we have a non-resident board for surveillance for the G20, and that's where the action is increasingly growing. I think emerging markets, well, they have excessive influence. I think we're trying to rectify their lack of reasonable representation and influence. And I think at the staff level, it's not politicized. Most of the staff who were hired from emerging markets, were educated at Chicago, MIT, Harvard. I don't think there's much risk on that side. I think it really is at the senior management level and at the board level. But the real issue is rectifying the gross European overrepresentation at this point. Thirdly, on Ted's proposal, ingenious. If he thinks Congress can be scared enough to act, that would be terrific. I guess I worry that I'd rather have a handicapped hegemon there at the fund than no hegemon. I mean, U.S. leadership has been critical for the fund throughout its history. I mean, I've seen periods of benign neglect out of the Treasury, and those have not been good years in my experience. The fund needs strong U.S. participation and leadership, and I think the result we have to look for is something that can bring that about. And just the last comment, it's actually all Canada's fault. Jim Boughton did an interesting piece which I think was on the table out front on history of Canadian roles in the IMF. But one of the things, there's this myth, Jim says, that the agreement was Europe gets the MD and Americans get the World Bank. Well, turns out that apparently the Americans wanted a Canadian as the first managing director, and went after two distinguished Canadians who both said no way, and so they turned to Europe as a fallback. So it's really all Canada's fault. Thank you, Jim.
It's hard to follow that. I'm gonna make a obligatory but heartfelt thank you, and then I'm gonna make one substantive point. The obligatory but heartfelt thank you is to all of you who participated, but particularly my colleagues Hung Tran from the IIF and Domenico Lombardi from CIGI, who worked together to put this great conference together, but also people like Mazar Minovi and Anna Gelpern and everyone who came together to speak and give us, so much to think about. I think it's been constructive. I think it's not been too depressing. And I think it shows how much even the fond friends of the IMF are trying to engage with its limitations and foibles. My substantive point is to depress you a little, which is to say, Charles and Ted are worried about being above their pay grade. My title is president, so I can do whatever the hell I want. Fred taught me that. It is shameful that the U.S. Treasury Secretary has been unwilling to cut deals, or the president has been unwilling to cut deals. And it's not just the IMF. This is simultaneously at the time that the U.S. administration has been unwilling to cut deals or push hard enough or build the kind of coalition Charles talked about for trade promotion authority. And the kinds of costs we're talking about are, as Athanasios, I think, articulated very well, hijacking of situations by locally powerful actors and problems that get worse rather than getting resolved quickly. And that doesn't even touch the opportunities that the U.S. is foregoing. And so when we came up with the provocative title, IMF, What Is It Good For?, I think it was obvious to all that we wanted to make the sound intellectual case, but the honest case for why it's good for the U.S. and for the world, and that there is a set of policies that can be in the U.S.'s own interest sufficiently to carry the day without being seen as making the IMF a stalking horse for the U.S. And I would call upon everyone in this room, whatever you think of Ted's specific proposal or Athanasios' vision of the euro area or whatever, to think in those terms and make that case. Because the U.S. government, both Congress and executive branch, are moving backwards now in a way that we've often worried about but rarely seen. Thank you very much.